Technical analysis versus fundamental analysis is often framed as a rivalry, as if traders must choose sides in an intellectual debate and defend that choice for the rest of their careers. In reality, this division says more about how people seek certainty than about how markets actually function. Trading literature written by practitioners who have navigable longevity tends to approach this topic with far less dogma. It reveals that technical and fundamental analysis are not opposing belief systems, but different lenses through which the same underlying reality is observed, one through price behavior and the other through narrative and valuation. And the real question is not which is superior, but how each shapes decision-making under uncertainty. Technical analysis begins from a simple but profound assumption: everything that is known, feared, or hoped by market participants is ultimately expressed in price. Charts, patterns, trends, and levels are not magical constructs. They are records of collective behavior. Every breakout reflects agreement. Every rejection reflects conflict. Technical analysis does not ask why something is happening in the world. It asks how participants are acting right now. This immediacy is its greatest strength. It anchors decisions in observable behavior rather than interpretation, allowing traders to respond to what is actually happening instead of what they believe should happen. Because of this, technical analysis is inherently pragmatic. It provides structure for timing, risk, placement, and execution. Support and resistance define where decisions cluster. Trends define directional bias. Volatility defines how much room a trade needs to breathe. Trading literature consistently shows that technical analysis excels at answering tactical questions: where to enter, where to exit, where the idea is invalid. It does not promise truth about value or future outcomes. It promises a framework for acting coherently in the present moment. Fundamental analysis, by contrast, begins with a different question. It asks what something is worth and why. It seeks to understand economic conditions, earnings, interest rates, supply and demand policy, and narrative forces that shape long-term perception. Fundamental analysis builds stories about value and imbalance. When done well, it provides context that charts alone cannot. It explains why certain markets trend for years, why capital rotates between sectors, and why sentiment shifts slowly before price reflects it. Trading literature often notes that fundamentals shape the environment in which price moves, even if they do not dictate the exact path it takes. The strength of fundamental analysis lies in depth rather than precision. It is slower, broader, and more interpretive. It helps traders and investors understand the forces that create sustained opportunity or sustained risk. However, this strength is also its weakness. Because fundamentals rely on interpretation, they are vulnerable to bias. Two analysts can look at the same data and reach opposite conclusions. News can be framed bullishly or bearishly, depending on expectation. This ambiguity makes fundamental analysis powerful for forming conviction, but dangerous for timing, especially in the hands of those who confuse narrative with certainty. One of the most important insights from seasoned trading literature is that technical analysis and fundamental analysis operate on different time horizons. Fundamentals tend to influence longer-term direction and regime, while technicals govern short to medium-term behavior. Problems arise when traders mix these horizons unconsciously. A fundamentally sound idea entered without technical confirmation can bleed capital for months. A technically perfect setup, traded against a powerful fundamental tide, can fail repeatedly. The conflict is not between methods, but between mismatched expectations. Another critical distinction lies in how each approach handles uncertainty. Technical analysis accepts uncertainty explicitly. It assumes that price can do anything and focuses on managing risk when it does. Fundamental analysis often seeks to reduce uncertainty by explaining causality. This can be comforting, but it can also create attachment. When traders fall in love with a fundamental story, they may ignore price signals that contradict it. Trading literature is filled with examples of traders who were right fundamentally and lost money because they were wrong tactically. At a deeper level, the debate between technical and fundamental analysis reflects two different psychological needs. Technical analysis appeals to those who value clarity, structure, and immediacy. Fundamental analysis appeals to those who value understanding narrative and context. Neither preference is inherently better. Problems arise only when traders use one method to satisfy the wrong need. For example, using fundamentals to justify staying in losing trades, or using technicals to trade noise without understanding broader forces. What experienced traders eventually discover is that the most dangerous stance is ideological purity. Markets are not ideological. They do not reward loyalty to a method. They reward alignment. Trading literature often emphasizes that rigid adherence to either technicals or fundamentals is usually a sign of insecurity rather than mastery. Flexibility guided by clear rules and honest self-awareness outperforms belief every time. This is why many mature traders stop asking whether technical or fundamental analysis is better and start asking how each can be used responsibly. Fundamentals may define what to focus on and what to avoid. Technicals may define when to act and when to step aside. When combined thoughtfully, they reduce blind spots rather than create conflict. Yet even this integration must be approached with restraint, because more information does not automatically produce better decisions. And it is precisely at this point, when the trader stands between price behavior and narrative explanation, that the deeper complexity of this comparison begins to reveal itself. And the sentence itself has not yet fully reached its end, where the comparison between technical and fundamental analysis stops being theoretical and becomes intensely practical. This is the stage where traders begin to see that the real risk is not choosing the wrong method, but misusing the right one. Markets do not punish analysis, they punish attachment. Whether that attachment is to a chart pattern or to a macro narrative, the outcome is the same when evidence changes and the trader refuses to adjust. At this level, technical analysis reveals its deepest value. It is a constant feedback mechanism. Price does not argue, explain, or persuade. It simply moves. When a technical premise is wrong, the market invalidates it quickly and visibly. This is why experienced traders often describe technicals as intellectually humbling. They force confrontation with reality in real time. Stops get hit. Levels fail. Trends break. There is no room for debate. This immediacy protects capital, but only for traders willing to listen when the market says no. Fundamental analysis, on the other hand, reveals its deepest value over time. It explains persistence. It explains why certain moves keep going long after they appear expensive, and why others fail repeatedly despite looking cheap. Fundamentals help traders understand regime, whether inflationary or deflationary forces dominate, whether liquidity is expanding or contracting, whether policy is supportive or restrictive. This understanding shapes patience. It helps traders avoid fighting large structural forces with short-term tactics. When used properly, fundamentals do not tell you when to trade. They tell you when not to be surprised. The most common mistake traders make when combining these approaches is hierarchy confusion. They allow fundamentals to override risk, or they allow technicals to override context. A mature integration establishes a clear chain of authority. Fundamentals inform focus and bias. Technicals govern execution and risk. When price contradicts a fundamental view, the professional does not argue with the chart. They step aside or reduce exposure. They allow the market to prove them wrong cheaply, rather than prove themselves right expensively. Trading literature repeatedly emphasizes this principle because it is violated so often and punished so consistently. There is also a timing humility that emerges here. Fundamentals often move slowly, but price reacts quickly. News is not the catalyst. Positioning is. When everyone already believes a story, the marginal buyer disappears and price turns without warning. Technical analysis catches this shift early because it reflects behavior, not belief. Traders who rely solely on fundamentals often miss this transition because the story still sounds convincing. Those who respect technical signals recognize when conviction has become consensus, and consensus is often where risk increases. Over time, many traders discover that their preference for technical or fundamental analysis says something important about themselves. Some are wired to act quickly, manage risk tightly, and accept frequent small losses. Others prefer fewer decisions, deeper conviction, and longer horizons. Neither preference is wrong. Problems arise only when traders force themselves into methods that conflict with their temperament. Trading literature consistently shows that method alignment with personality matters more than theoretical superiority. The best analysis is useless if it cannot be executed with discipline. Eventually, the debate fades. The trader stops asking which analysis is correct and starts asking which information is actionable right now. Actionability becomes the filter. If a piece of information cannot change position size timing or risk, it is often noise. This discipline dramatically reduces cognitive overload. It allows traders to remain informed without being overwhelmed, contextual without being paralyzed. At its most refined level, the integration of technical and fundamental analysis becomes less about tools and more about posture. The trader stands lightly on both, willing to lean into either when appropriate, but never anchoring identity to one. They are prepared to act when price confirms, and prepared to wait when it does not. They respect narratives, but do not worship them. They respect charts, but do not idolize them. This balance is not indecision. It is maturity. And so the deep dive into technical versus fundamental analysis resolves not with a verdict, but with a realization. Markets are too complex to be captured by a single lens. What matters is not which analysis you use, but whether you use it with humility, structure, and awareness of its limits. When that awareness is present, analysis becomes a servant rather than a master, supporting decisions instead of justifying them, and trading becomes less about being right in theory and more about being aligned in practice, a shift that continues to refine itself as long as markets evolve and traders remain willing to adapt rather than defend their beliefs.